Bloomberg Audio Studios. Podcasts, radio, news.
This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. The Bloomberg Businessweek Daily podcast with Carol Massar and Tim Stenovec on Bloomberg Radio.
Hi, everyone. Welcome to the Bloomberg Businessweek Weekend podcast. This past week, it was largely about the news flow from Washington to Wall Street, and that included shifts on U.S. trade policy with global allies and renewed pressure on the Fed, to the White House fast-tracking its AI infrastructure build-out. And, oh, right, a busy and big earnings week.
On that, this first hour, what you need to know about results from two members of the Mag 7. We talk Alphabet and Tesla. One traded down on earnings, the other initially sold off, only to rally.
And speaking of Tesla, we get into the relationship between Elon and the president, recently feuding, and yet this past week, President Trump perhaps offering an olive branch as he put out on social that he wanted Elon to thrive. Elon's universe is the cover story of the upcoming new issue of Bloomberg Businessweek.
Plus, one real estate investor finding opportunities in solar. We'll explain all that to come. We begin with two of the big earnings this week. First up, Alphabet, which said demand for AI products boosted quarterly sales and now requires an extreme increase in capital spending, heightening pressure on the company to justify the cost of keeping up in the AI race. To
help break down Alphabet's quarter, we leaned on Laura Martin, senior analyst at Needham & Company, who has a buy rating on Alphabet.
The single most important number to offset the bears is the search number. So search revenue up 12%. Was well above the whisper number of 10% growth and above the Wall Street consensus number of 9% growth. And they also had 4% click volume, which basically is the same as last year. And that's up from 2% click-through rate in the first quarter, which is positive because the bear case here is that generative AI answers lower than the economics of Google search, which is the big money engine here. So the single most important number was that search grew ad revenue 12%, which was 300 basis points above consensus view. The second most important number is cloud. Right? They're still out of capacity with cloud, but their cloud business grew 32% at a 20% margin. So that's fantastic. So they're really pricing up now that they have capacity constraints. And the third most important number is YouTube. YouTube grew 13% of revenue, and we think it's worth $73 a share here if it was separately tradable and not confined within the Alphabet conglomerate. So, but I would say those are the three most important segments that people are talking about. But the bear case really is highly focused on the search revenue growth.
And that's exactly where I want to go right now. Going into this print, there was so much concern about the cannibalization of traditional Google search. Why aren't we seeing that?
So what they're saying is that what happens when you have those answers, when you put in a Google search and then you get an answer, is that people are spending 10% more time asking the next question. And that the shortfall in clicks per query is made up by the fact that people spend 10% longer, which then lets Google serve more queries or more ads. So that's what they're saying, is that the monetization is about equal. That's their words, about equal. But I think part of it is the extra time people spend using the answer format is offsetting the actual the downdraft in the economics per query.
Hey, the extra spend, the up again CapEx, initially everyone was saying, well, that's why the stock traded down in the aftermarket. It made some folks, or at least some investors, it felt like, initially nervous. What is your take on that? I think our own Mandeep Singh was saying, well, listen, it sounds like they are getting the demand and they're spending to meet that demand.
Yeah, I mean, I would say that. I would say the other thing that's going on is that I think one of the reasons the stock was a little volatile is the operating income grew 14%, the top line grew 14%, and it sort of looked like there was minimal operating leverage. But what they told us on the call that was buried in the financial statements is those costs included $1.4 billion fine, legislative fine, regulatory fine. So if you subtract that just to look at costs, the most important point we would make that I think largely is being missed, it doesn't have to do with revenue, has to do with the fact that by integrating generative AI into every aspect of their business, they've got really accelerating revenue, which everyone's focused on, but their costs are going down. Okay, that's not fair. Their costs are just not going up as fast. There's a lot more operating leverage here if you exclude the fine. So I think that's why I think once they said there was this big fine in the costs, people realize that generative AI is really lowering or increasing the productivity here. And so the operating leverage is at margin expansion is faster than people think at a time when revenue is also accelerating over consensus view.
One thing I loved in your research, and you put this right up top, Laura, is you said we like Google's strong strategic position as number one in search, number one in streaming, YouTube, number two in mobile, Android, number three in cloud, number one in autonomous driving, Waymo, which Tim and I are both in love with. And you say LLMs make data more valuable and Google's data is best in class. Again, your view. Is Alphabet in many ways the one to beat? And why hasn't the stock been, I don't know, doing more this year?
You know, I think Google, so I would say their execution has been very haphazard. It's not. And Wall Street really prefers leaders that lead from the front, like Meta, like Mark Zuckerberg. We like, visible, clear, visionary leaders. And that's not what's going on here at Google. But, Google, sort of despite itself, really does have the human capital and culture and financial resources to fund what will be a retooling of American business, which is the generative AI backbone infrastructure that they're building. And they're leading by executing within their own, they're showing what's possible by executing, implementing generative AI into everything they do, every product they have, and every cost center they have. So this is what's about to happen to America over the next decade, is companies that follow Google's lead will have increasing margins and accelerating revenue. And if you don't, which requires a cloud, by the way, you can't do this without cloud. If you don't, you will go out of business because in my opinion, because the companies that use generative AI to increase productivity and margins and increase revenue will get higher multiples from Wall Street.
I know you said search, cloud,
streaming,
search, cloud, and YouTube are the three most important numbers, but we'd be remiss if we didn't ask you about Waymo and the expansion that the company said is coming in the quote near future. Here's what they said. Alphabet hopes to expand Waymo to all cities in the near future. How do you look at this as an analyst on this company's stock, as an analyst for the company, and material contribution?
So you guys love the service. You just said so. So I don't like it in this sense that right now, I think the most strategy is what you say no to. And what Google should be saying no to is anything that isn't generative AI related, because this is a race and a war. And they are spending a fortune on generative AI. Good for them. But Waymo is another huge sunk cost or financial commitment. And I would like them to figure out a way to do Waymo. They are ahead. They are number one in autonomous driving. I would like them to keep the data, because I think data in the real world plus the virtual world is worth more than either world standalone. So I like the data aspect of Waymo, but I do not like the capital commitments, which compete right now with the generative AI capital commitments.
What are the capital commitments? They haven't been totally clear about that. What do you view them as?
Well, they sit in other bets, and I think other bets I'm forgetting, but it loses typically $3 to $5 billion a quarter. So it's like 20 billion a year. And a lot of that is Waymo, and it's their healthcare initiatives. And so I just think that money, they just upped CapEx by 10 billion. I would like to see them take it out of other bets, but the primary other bet is Waymo. So I think they're unwilling to relinquish their pole position because now Tesla's coming after them. So I think, look, they are number one in all of these strategic segments because they get there early. And so they're early to Waymo. I just wish it wasn't as capital intensive. The losses weren't as big at a time when Google should be spending all of its focus and resources on generative AI.
Laura, we really, really, really like Waymo. I'm just going to tell you, really, I even close my eyes in a Waymo. That's how comfortable
Laura's
I felt.
in LA where they have Waymo.
I
We're
know,
in New York
she
where they don't have
knows.
Waymo yet,
I know.
so.
Hey, listen, we've got about 3 minutes left. There's so many different places we would love to go with you, but you pick, because we've got Apple reporting next week, Meta reporting next week, Amazon reporting next week, Disney in early August, Netflix already out, and then there's the late night wars. What's interesting to you right now that you think the Bloomberg audience and investors really need to be paying attention? And it can be something else beyond that.
Let's do Apple, because it used to be the biggest company in the world. Now I guess NVIDIA is. But what I would say about Apple, we have a hold here on Apple, whereas we have a buy on Alphabet, Google. I think Apple is in a box, because when you listen, for sure, when we hear Meta, who's spending hundreds of millions of dollars per person to create a super intelligence generative AI group, and yesterday there was no sentence on the Google earnings call that didn't have AI in it. So, these companies are really talking. Amazon will also, because Amazon now is being run by the AWS, founder, essentially. He talks about generative AI a lot. So the one that's not the same is Apple, and people really want to see what's happening with their generative AI strategy. And how is Apple either 16, iOS 16, iOS 17, iOS 18 going to keep up with Android, which is Google, who last night told us they're integrating generative AI tools into everything, including Android. So I do think there's a bigger threat to Apple's only business, which is its iPhone business. We think it's a single product company with upsells to other devices. We think the anchor tenant there is the iPhone. So we really want to hear how they think they can compete when they are saying nothing about generative AI. And they're spending $12 billion on CapEx, which is the same number at Apple for the last 3 years. When every single quarter, we show up on the Amazon call, the Meta call, the Google call, they're raising CapEx by $10 billion at a time, every quarter.
30 seconds on Apple. Is Tim Cook the right leader to guide them through the AI era?
Oh, so harsh. I'm going to go with no, but so harsh. No, I don't think so. I think we need a wartime CEO. And I think Tim Cook is great at a lot of things, but I don't think he's not proven great at this technological disruption called generative AI.
Got someone else in mind that you think should lead it? 10 seconds.
It's an impossible job. So no, I have no idea in mind for who could replace him.
You rock. Come back soon. And I think you are coming back soon, which we're looking forward to already. Laura, be well. Laura Martin, senior analyst at Needham & Company, knows this space like no other. So glad we could get some time.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App, or watch us live on YouTube.
All right, let's stay with earnings, and from another Mag 7. We're talking about Tesla, which its shares fell after Elon Musk warned of difficult times ahead for the company, following one of its worst stretches since it first started producing electric sedans over a dozen years ago. Tesla will be in a transition period for the next year or more, losing electric vehicle incentives in the United States and needing time to roll out autonomous vehicles. That, according to the chief executive, Elon Musk.
Ross Gerber is a longtime investor in Tesla and owner of Tesla cars, including the Cybertruck. He's the CEO of Gerber Kawasaki Wealth. And while he's been a longtime Tesla advocate, more recently he's been a vocal critic of Elon Musk. He joined us to reflect on his cautious optimism.
I think probably my biggest issue is that what I believe is best for Tesla isn't actually the strategy being employed by Elon. And what I think is best for Tesla is to be focused on selling great EVs that can drive themselves versus completely pivoting into this robot and robo-taxi business because they're struggling to sell cars. Because what we're seeing now, which I suspected to be true earlier, is that the deterioration of the EV business is really, really bad for Tesla, and it essentially is an EV business. And so hoping that robotaxi and robotics is going to be a revenue stream and let alone profitable anytime soon is really just not going to happen. And so, as Elon said, Tesla's in for some pretty tough quarters ahead. And with the ending of the tax credits and all this kind of stuff, I mean, this is all bad news.
When you say it's not going to happen anytime soon, what do you mean by that? Give us your own timeline here.
Well, we follow Waymo very closely, and we think that Tesla is 2 years behind Waymo as far as the development of their robotaxi. And now Waymo is scaling and being quite successful at charging, the right amount for rides and generating enough revenue that it's meaningful. So I think it's at least 2 years, right? So where Tesla's at, for them to generate any revenue at all of meaningful ability will take a couple years. And then from a profitability standpoint, we don't even know if that business is going to be profitable with all of the competition that's coming into the robotaxi business.
So you said that you've been selling shares of Tesla. I think there were reports too in June that you sold about $60 million worth of Tesla shares, and you cited the waning confidence as you're laying out here in the company's future. Are you selling more? What's your exposure at this point?
Yeah, we still have, on my last 13F, we had over 200,000 shares. Right now we're holding a little less than 200,000 shares. So we continue to sell the stock. We have a lot of diehard Tesla clients that you have huge gains because we bought the stock at, like $2. And so, people aren't that excited to pay taxes. And there's still this possibility that Elon could change course and really do the things necessary to fix Tesla, because fundamentally Tesla's a great company. Most, if not all, of Tesla's problems are self-created because of the CEO, Elon Musk. It's not that Tesla's core business has some big problem. It's actually the opposite. The CEO is the problem, which is super unique. So that's why I'm loath to just be like completely out of Tesla. But on the other side of the coin, with the valuation where it's at, and basically we think they're not going to be profitable next year, the stock needs to move meaningfully lower in my mind before I would buy it.
How low? What's meaningful?
Well, I don't know if any of the analyst estimates for next year are right. I think they're all vastly overstated. But even if you did $3 of earnings next year at 50 times earnings, which is NVIDIA's multiple, you'd be at $150. And then you put some premium on the Elon Musk robot premium. Maybe you put on $50, $100. So you're at, $200 to $250 a share is where I think Tesla should be.
Hey, Ross, in the past when we've spoken to you, you've been really critical of Tesla's board. You've been critical of it on social media as well. The board does include folks such as Kimball Musk. It includes James Murdoch. Most recently, it added Chipotle's Jack Hartung to the board. Are you any less critical of the board now? Do you think the board is doing its job?
No, I think there is no board. I think the board is Elon Musk. And so the board is just, it's like a weekend at Bernie's, it's like a bunch of bodies that they put at a desk and Elon tells them what to do and they do it. This Jack guy they just put on probably had no idea what he was getting himself into, and he's in deep now. So I don't actually think the board of directors cares about anybody but Elon Musk. And I think investors in Tesla know that at this point. And that's why we're ultimately sellers, is nobody actually represents retail investors, which still own 87% of Tesla. So it's really a unique situation. And I expect Tesla to buy XAI at some point for probably $200 billion, some outrageous price. And I think that's the next thing that will happen. So there's no question that the merging of these businesses seems to be on the horizon.
Hey, before you go, I definitely want you to have you weigh in, Ross, on what President Trump put out on social, that he denied he was seeking to ruin Elon Musk's business empire as retribution for the dispute over the president's signature tax law. What's your read on this? Might this be helpful to Elon and Tesla? We just got about a minute 10.
No, Trump's just being the bigger man here and trying to, act like he doesn't have a tiff with Elon, because he's so mature or something. But the truth of the matter is he's already done what needs to be done to destroy Tesla by taking away all the subsidies and making EVs much more expensive. And so, he doesn't have to say anything anymore. Elon's dug his own grave, and he's going to have to figure out a way out of it. So Trump doesn't have any reason to look bad or grind an axe, and Trump's playing Elon like he has the whole time.
30 seconds. We have talked with you about your Cybertruck. We talked about others, that you have owned. Would you buy another Tesla? Do you still like the cars? Just quickly.
I do. This is the whole issue. I've looked at so many other cars to buy, and I want an electric car, and I want a great electric car, and I still think Tesla makes the best cars. And Rivian, I have a Rivian too, so I think they're a close second, and they make a great vehicle as well. But I just haven't been compelled by any of the other vehicles, EV vehicles out there. And so, I still kind of like my Cybertruck, and
I know.
I can't sell it anyways, but Tesla makes great vehicles, and it's a great time to buy an EV before the discounts go away.
Ross Gerber, you're incredible. Of Gerber Kawasaki Wealth. We so appreciate it.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Safe to say, so many called it that the bromance wouldn't last between the world's richest person and the U.S. president. The breakup happening after disruptions to the U.S. government under what some say was the guise of efficiency and data foraging.
We are talking, of course, about Elon Musk and how his companies, specifically Tesla, SpaceX, and xAI, are struggling in the wake of his feud with President Trump. This past week, Bloomberg reported that a risk factor statement was sent to SpaceX investors, including Elon's desire to get back into politics.
Certainly a whirlwind for those invested in Elon's empire. Writing all about it as the cover story for the upcoming issue of Bloomberg Businessweek is Bloomberg's Max Chafkin and Ed Ludlow.
Max is Bloomberg Businessweek senior reporter, also the co-host of the Everybody's Business and Elon Inc. podcasts. He joined us to break down how Elon's empire may be creaking under the strain of his antics.
He's the wealthiest guy in the world, and investors to date have essentially allowed him to do whatever he wants and to do things that most CEOs, most entrepreneurs would never be able to essentially get away with. That said, there are, I'd say, bigger challenges facing these companies today than he's experienced in a very long time. Of course, Elon Musk has a history of sort of flirting with disaster. And you look at the history of Tesla, there were some very dicey moments in the 2000s, same thing with SpaceX. But you haven't had this situation that we have today where you have essentially three companies, SpaceX, Tesla, and xAI. I'm going to leave off the sort of smaller ones, but those are out there too. And then in the foreground, you have this potential fight with Donald Trump. And so, everyone's focused on the fight, but those three companies, each in their own way, have very significant challenges.
So let's get to it, because you do right. There are many more weapons President Trump could deploy against Elon Musk's business interests were he so motivated. So much is like, does he or doesn't he? Let's start. I love the way you guys do this. You do basically like these case studies of each of these three businesses. So let's talk about Tesla. He makes promises. Sometimes it takes longer. We have all gone along from the ride that we eventually get this stuff. And to be fair, when it comes to EVs, certainly in the United States, he moved the needle.
Yeah, absolutely. And that's what's made, I'd say, the events of the last couple of years so surprising, because Elon Musk is attempting this very dramatic pivot away from EVs and towards robotaxis, which is kind of strange because the EV market is still growing very quickly. Mm-hmm. Tesla, on the other hand, it is not growing. I mean, their deliveries have been falling for the last 2 quarters, had a down year in 2024. We'll see what this latest quarter looks like when they report earnings, but they are selling fewer cars each quarter than they did a year ago. And that is kind of surprising for a company that is trading at just this insane multiple, trading at a value that is way, way, way richer than a normal car company. Now, of course, the reason investors are going for this, the reason they're continuing to buy the stock at a relatively high price is because of robotaxis, this belief that Elon Musk is going to revolutionize transportation. The issue is that's been this kind of thing that Musk was able to point ahead in the future and say, look, this is going to be great. Don't focus on the now, focus on the future. And now we have the now. Now we have some robotaxis on roads, and it's really a very small number. It's something like 10 to 20 robotaxis in a very small part of Austin. Meanwhile, you got Waymo, and we've talked about this before, but there is this obvious competitor Waymo, which has way more robotaxis in more markets and is not getting valued the way that Elon Musk, the way that Tesla is getting valued. So you do wonder, how long is it before investors start to look at that, and how many quarters of sort of declining deliveries, declining car sales are they really going to tolerate?
These companies have sort of always, Elon Musk's companies have always kind of used one another and shared engineers at certain points. Now we're getting to a point, Max, where Elon wants more investment from one company to another company, specifically Tesla, to invest in XAI, which is a challenging thing to do because Tesla's a public company. XAI is not. Shareholders might not love this idea. Explain the sort of borders or lack thereof when it comes to this accounting.
I mean, the thing is, from the point of view of Tesla investors, and I think this is true of most of the investors in most of Elon Musk's companies, they're not investing in a particular product. They're just investing in Elon Musk. And that's one of the reasons why, even when Musk does something that seems on its face a little bit foolish or crazy, for instance, the on again, off again purchase of X at a ridiculous, overvalued at the time, investors go along with because they just think, okay, Elon Musk wants this. He's a brilliant guy. And so you have this thing where the companies, although they are nominally independent, are sharing resources, sharing management, of course, not just Elon Musk, but other folks, sort of bouncing between them or doing work on the side. And now even you have XAI, which is desperately trying to raising money from Elon Musk's other companies. SpaceX, according to Elon Musk, putting $2 billion into XAI. And then Musk has said he's going to ask Tesla for money and a year ago he suggested the number would be $5 billion. So you're talking about significant amount of money. Tesla, of course, has a lot of cash at the moment. So it's not like it can't afford it. But you got to ask yourself, what is the rationale? Like, what's the business rationale if you're a Tesla investor to, move money from Tesla to X, especially when X and Tesla are sort of in competition. They're both AI companies. And so that's an issue. I mean, what I think it shows is that as much as these companies, add up to this big empire, they're interlocking. And if one struggles, the others are going to struggle. If Tesla's value were to decline dramatically, that would hurt Elon Musk's empire in a big way because Tesla shares are a big source of his wealth, a way he finances things. And beyond that, there's this aura of success that he has used to sort of promote himself and promote these companies. And as that has, I'd say, come into some question, I think that hurts some of these other companies.
So he did post on X that he's back to working 7 days a week and sleeping in his office if my little kids are away. Yay. But I'm just wondering, which part of his empire is he most interested? You guys talk about XAI, that's what he seems to be super interested in right now. Yeah,
and you get different answers depending on who you talk to within the empire because, of course, Tesla also feels like Tesla employees, board members also feel like they are in the middle of this really unique opportunity with robotaxis. But yeah, I mean, Musk has spent, it seems, at least over the last couple of weeks, a lot of time with XAI and Grok. Now, of course, AI chatbots, that's an area that a lot of investors are excited about. On the other hand, this is a very expensive company to finance. Bloomberg has reported that they're losing $1 billion a month. So like that, $5 billion from Tesla, they're gonna burn through that, pretty quickly. I think from the sort of bull case is, hey, these large language models are really expensive to finance, so we need to, put as much into them now, catch up to OpenAI. But of course, the other side of the coin is like, why does this very successful car company that's worth $1 trillion by market cap, what does it have to do with AI chatbots? I don't think that the answer is a whole lot.
Yeah.
Elon Musk claimed without evidence that President Trump was an accomplice in the crimes of Jeffrey Epstein and alleged that the president had covered them up. This was sort of the nadir in their relationship, I think, if we look back over the last 6 weeks. Is there any recovering from that? Like, do they get back together? Do they become allies again?
I think it is very hard to see. I mean, obviously, those are very serious charges. I mean, sort of like the most serious charges in Republican politics. And it's led to a news cycle, right? That happened, as their feud was kicking off at the beginning of June. Now we're in, mid-late July and Republicans are still talking about Epstein quite a lot. So yeah, I mean, it's been a bad. That's a thing that's going to really throw a wrench in any kind of, potential makeup. Now, I will say Trump and Musk are both, this is going to sound weird, but they're both kind of forgiving. They both, although they like to cultivate this, both of them, alpha image or whatever, they have, Trump has done this where people have been on the outside and then they find their way in. Steve Bannon, of course, famously was very much on the outs. Now he's no longer on the outs. Musk is the same. Musk, will get very mad at people and find a way to get them back in. So I wouldn't discount it entirely just because, and I've said this on your show before, there are reasons each of them has an interest in being on good terms with the other. That said, I mean, it has seemed very difficult, and you're seeing now. We get into this in the story. There are lots of signs, if you're looking closely, for ways in which this relationship is hurting Elon Musk today. Now, I'm not just talking about Jared Isaacman, the person that Trump originally nominated to head NASA, the space agency, who was close to Elon Musk, who's out now. But there are lots of little regulatory moves, policy moves. And just to give you one example, the guy who's going to run NHTSA, at his confirmation hearing, suggested that we need to have more oversight of autonomous vehicles.
If you're Elon Musk, you don't want to hear that when you have a fleet of robotaxis that you're trying to get on the roads.
Yeah, you absolutely don't. And so, Sean Duffy running NASA now, he was, according to at least some reporting from inside the White House, was one of the people who was really upset about Doge. So you're seeing these little things that are potentially troubling if you're Elon Musk, and certainly cut against the sort of bull thesis around the time of the election, which was like, these guys are perfectly aligned. This is going to be amazing. I mean, that's what sent the stock up to its, crazy heights in mid-December. And it's fallen, I think last I looked, around 33% since then, as that argument has sort of fallen apart.
It's, as you guys say, you can't count out Elon ever, but it is curious to see how this ultimately plays out and whether or not he becomes a target of the administration potentially. Hey, Max, thank you so much. Really appreciate it. Bloomberg Businessweek senior reporter Max Chafkin. Max and Ed Ludlow writing this story. It's an upcoming issue of Bloomberg Businessweek. It is the cover story already on the Bloomberg and at Bloomberg.com.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
It would also unleash it just by lowering the interest rates. If the Fed would lower the rates, we wouldn't even have to do that. But we are thinking about no tax on capital gains on houses.
That was President Trump this past week with a statement that caught our attention. The president taking questions in the Oval Office during a press event that he is considering a proposal to end capital gains taxes on home sales. And I got to say, caught my attention and sign me up.
Are you planning to sell your home anytime soon?
Not anytime soon, but, when you've been in a home for a long time and it was a market that was pretty dead, there's been a fair amount of appreciation. So, yeah.
But can't you also, have you been keeping track of all the improvements that you've made over the years?
Yeah, I don't know how good the files are, but yes.
I'm sure they're on your desk somewhere, Carol.
I actually, it's so funny that you say that because I'm always like to my husband, all right, give me the receipt, give me the so yeah.
Yeah, just
there's some bank statements.
Just keep track of that and then it becomes your accountant's problem.
Yeah, exactly.
Hey, it's still a developing story, so nothing official yet, but under current laws, single filers are exempt from paying taxes on capital gains of $250,000 or less for the sale of their primary residence, while married couples filing jointly are exempt on up to $500,000. This new proposal would eliminate that cap.
That's why it caught our attention. Legislation that, if passed, could impact millions of homeowners. For the latest on this and the latest on housing, head to Bloomberg.com or check out the Bloomberg terminal.
I've been thinking about this, and it's one of those things. First, you'd have to find where you'd offset that revenue loss when it comes to capital gains. But it's also one of those things, Carol, that I think would, again, disproportionately affect the wealthier people in this country because it's homeowners who've owned their homes for a very long time. Mm-hmm. So they would see the benefit, not necessarily the folks who the president has talked about wanting to be able to afford homes, those first-time home buyers that he's talked about not being able to get into those homes the way they were, like their parents were able to. I mean, we even talked to a real estate agent this week who talked about first-time home buyers being in their 40s now as a result of high prices and high rates.
Also, she talked about multi-generational home buying. So older folks, either passing on their homes or helping out, their kids and then living with them with the understanding. I agree. It doesn't necessarily get to the housing affordability problem that has persisted, to be fair, not just this year, not just last year, but has been around for many, many years. We have a great voice, though, on housing that we like to talk to. Plays into the multifamily very much in the south of the United States. We're talking about Thomas Carroll. He's founder and chief executive officer of Ballast Rock Asset Management. The firm has about $600 million in assets under management and, as we said, focuses on multifamily real estate and private equity.
The industry as a whole has been white knuckling, I would say, with an expectation of rates coming down. They've been white knuckling the sale of assets. We're primarily in the secondary market rather than developing, specifically in multifamily.
But you still have to do a lot of work to those multifamily.
Absolutely,
homes.
We're doing massive renovations, and so inflationary costs around that are material, etc. But yes, the rates environment has had a tremendous effect on the multifamily market, and until rates come significantly lower or sellers reprice in a material way, then it's tough for the market to get started again.
That's what I wanted to ask you. If we just know, all right, the Fed's on hold because this is what's the policy that makes sense for the next 6 to 12 months, then folks are going to do deals, right? It's like having some clarity because historically we're still at a lower rate environment. We've had much higher rates. And I guess my point is, are people just looking for clarity on what the policy is? And there's just between the back and forth between the White House and pressure on Fed Chair Jay Powell, and maybe folks thinking that that could ultimately lead to lower rates. I mean, that uncertainty, essentially, and at the same time, tariffs, which are putting another layer of uncertainty. So the Fed doesn't know exactly what the environment's going to be. So they're on hold. So if at some point we have more clarity and the Fed says, nope, economy grown, we're doing good, Thomas, that then people will say, well, this is the environment. So we'll reprice and we can do stuff and we'll move ahead. Sorry, that was a long way of saying clarity.
Yes, indeed. Clarity would be extremely helpful. And perhaps you would have some owners be willing to transact again. However, a lot of owners still, asset holders still have 2021 and peak pricing in mind. And so it's hard to let go. It's hard to reprice an asset lower, especially an income generating asset.
Right.
So because they're income generating, you can hold on to them far, far, far longer than you would be able to otherwise, even if pricing theoretically should be lower if you were to sell, but you don't sell. You just hold on to it for years longer. But yes, hopefully greater clarity would be useful, but I would not say we're in a particularly clear environment right now.
No.
So clarity is not there. And so volumes in terms of secondary market volume for commercial real estate in general is substantially lower than it was at the peak.
So what are you doing? Are you not buying anything right now?
So we are not buying a lot right now. No, the only deals that we're doing are situations where the seller is genuinely in distress. So if there's not outright distress, it's very, very hard to make the numbers pencil. And what we're focusing on instead is actually where the big, beautiful bill has created a short-term window of opportunity, which is solar development, interestingly enough.
This is what I'm glad we're talking about this. It was in the notes, and our producer Ari said this on the phone, and I was thinking to myself, solar?
Yeah.
Because the concern, and we saw this play out in the public markets, was that solar companies would get hit hard as a result of this bill, and they've been under a lot of pressure. Where are you seeing opportunity?
They have been hit hard, and there is really very limited window for opportunity. So it's not great if you're full-time in that business, but for us, we're a private credit lender to solar developers that might have a 20 or 30 development pipeline of projects, and it enables us as a lender to step in on a senior secured basis and identify and cherry pick really the best, most actionable, immediately actionable projects where we can get shovel in the ground right now and bring these projects to fruition, because very shortly any investment tax credits are going to disappear. So it is about a short-term window, and for us the opportunity is as a lender. Absolutely, this bill has been extremely problematic for the development industry and for generation of solar power in the United States.
How short-term and what are the terms looking like?
So we need shovels in the ground this year or by the middle of next year if there is no foreign content. And we need completion of the project by the end of 2027. Some of the rules are still to be finalized, actually. The Big Beautiful Bill obviously passed on the 4th of July, but a week later, the Trump administration issued an executive order that the IRS has 45 days to clarify the rules. So interestingly enough, we're playing by a rule book that we don't fully have the details for.
You talked about lack of clarity.
Correct,
It
lack of clarity.
hits a lot of different areas.
That's right. But there is opportunity there in the short to medium term for us to help those small to medium-sized developers bring those rapidly deployable projects where we can get energy to the grid before the end of 2027 online immediately. But they need capital, and they're very profitable when you do it. And that's where we see the short-term opportunity in development.
Then do these projects go poof?
Well, no, the project will last for 20,
but I mean new
25,
projects,
et cetera. But
that's it.
If you have a 30 project pipeline, you might have 5 that you can bring to fruition. You might have 25 that go poof.
All because of tax credits.
Correct. Wow. Now, there will be major changes that are going to occur.
Yeah.
The cost of construction for solar projects, the EPC construction costs are highly likely over time to come down because if there's less development going on, those construction companies will reduce their costs. So there'll be opportunities there. There will also be opportunities for states that want to continue to incentivize solar to step in and provide credits where the federal government steps out. And then finally, the utilities themselves, which at the moment use the interconnection fee and other aspects of solar development to make money, they will probably compress their margins as well. So there are a number of different moving levers, and then ultimately the cost of electricity is going to go up.
Well, that's
going to be a huge driver of value.
This is what I wanted to ask you. What are the projects that you are investing in?
So the projects that we're lending money to are...
Or lending to, forgive me.
Exactly. For clarity, we're a private credit fund that lends money rather than investing equity.
Right.
But those projects are below utility grade. They're what are called community solar. So they're usually in the 5 to 50 megawatt project size, whereas community solar really utility grade solar kicks in above about 100 megawatts. Those projects, because they are much more challenging and time consuming to execute, a lot of those have gone, to use your words, poof, because they can't be delivered in that time frame. So there is a massive change in the demand, as we know, for solar as a result of AI, for electricity in general. But now there's a material change in supply for the negative.
Before we let you go, back to your focus on multifamily. In the past, you've been on with us and you've spoken excitedly about the Sun Belt. Where geographically are you thinking for opportunity now?
We continue to see a lot of opportunity in small to medium-sized cities across the Southeast, the Carolinas, Georgia, where these right-to-work states, where we're seeing a lot of new battery factories and other new factories being built. It's those small to medium-sized markets where we continue to see a growth in demand, an increase in wages, an increase in job opportunities, and we're there to do our best to support that with housing.
How would you describe the economy, just real quickly? The
Pretty
U.S. economy?
Strong jobs market, but a lot of lack of clarity around issues such as tariffs and rates that make it challenging for long-term deployment of capital.
All right, interesting. So it sounds like potentially a lot of stuff sitting on the sidelines, just waiting for some clarity.
That, certainly.
All right, good to check in with you. Thank you for coming in.
Thank you.
Yeah, appreciate it. Thomas Carroll, he's founder and chief executive officer of Ballast Rock Asset Management, joining us right here in our Bloomberg Interactive Broker studio.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Plenty ahead in our second hour of the weekend edition of Bloomberg Businessweek, including the luxury brand facing questions about how far is too far when it comes to exclusivity.
Plus, really excited for this one because we get to speak to our Bloomberg food editor, Kate Crater. She's stopping by. She's talking about the boom in YouTube chefs. New York influence also pervades the food and drink scene in London. Apparently, you can get a pretty good burger there these days, if you want it.
Pizza, too.
Pizza, yeah. Kate's also going to share how CEOs optimize their sleep routine. I was surprised to see some of these CEOs are not doing a very good job.
And I was too. I was amazed at how many. I expected like all these great
also
solutions.
Lie about it if you're not doing a good job, CEOs. Come on, be a good example.
This is part of your brand. All right. And while on the subject of food and chefs, a 1960s diner is one of the scenes in a new high-tech immersive show on Elvis Presley that unfortunately failed to impress. Elvis has left the building, and it sounds like maybe our reviewer wanted to do so as well. We'll explain. It's all in Bloomberg Pursuits.
First up this hour.
The Starbucks pumpkin spice latte is set to return to stores in just about a month.
Nuts.
That's nuts.
Come on.
Seems nuts to me.
Summer's
August 26th.
not even over.
I think it's a little
Do
too
you
soon
ice
to
it?
think about
Do you
fall.
say, sure, I'll have
Listen,
a pumpkin spice latte?
I stay away from it. Okay.
Yeah, I do too.
No matter what time of year it is. Speaking of the pumpkin spice latte, one of the most read stories over the last week is about the CEO who turned around Taco Bell and then turned around Chipotle. Can he now do the same for Starbucks? For Bloomberg Businessweek, Daniela Sartori interviewed investors, baristas, and Brian Niccol, the newish CEO who was lured to Starbucks with a pay package valued at about $100 million. He's been on the job for a few months, since September, so it's almost been a year, actually. The ceramic cups, a handful of made-over stores, and condiment bars are some of the changes he's betting on. Oh, and protein, too. Daniela Sartori is Bloomberg News restaurant reporter. She joins us from our Chicago bureau. She spent a lot of time with Brian Niccol. She did a lot of traveling for this story. Daniela, tell us a little bit about how Brian Niccol is doing in turning this company around.
So there's definitely been some progress. You know, Starbucks has already made some changes, like bringing back the condiment bar so people don't have to, complain to baristas about their drink being too sweet or too dark or too light. They've also started renovating some stores. They've started redesigning the menu. So definitely things that are going to make a difference. And, they do say that people are hanging out in stores more because they want to bring back that feeling of, it being like a coffee house and that they're ordering more coffee-centric drinks. But some of the big things, in terms of operations, which is such a boring word, but it matters so much when it comes to getting your drink quickly, are still being developed. Like, for example, the company is in the process of putting more workers in stores, which they are hoping will, speed up service and then also, give baristas a little time to, have a chat with you. But some of these big changes are still in the works. And so, it's definitely work in progress. And Brian himself has said that.
Well, we'll get to more on Brian in a second. But one thing that I really liked about your piece was it did a good job of laying out the challenges that Starbucks has faced in recent years. Can you talk a little bit about how it lost its way?
Absolutely. So, we can look back at sort of the pandemic. One of the things that happened was the company moved a lot to sort of that convenience-focused model, right? A lot of us weren't going to stores. Stores weren't even open. And so Starbucks actually started removing seats from stores. At the same time, there was this unionization movement ignited by several things, like baristas feeling like there was understaffing. All of that led to slower service at the company. Lines just have gotten very long. At the same time, people are like, well, this doesn't feel like a cafe anymore. And then, we also have some issues outside of the US, right? So for example, China has been very slow to recover because of the country's economic situation, and also just competitors that have undercut Starbucks. And so there are challenges on multiple fronts that the company has to confront right now.
It's interesting. I try to think about what it is that Starbucks has to deal with. They really kicked off, right? Kind of the coffee craze, right? And, not just getting a cup of coffee from a deli, but made it so much more. But the market that they really created is now a really crowded market. So is it just that it can't be just about coffee anymore, and that Starbucks has to mean something beyond that, like food, a cafe you hang around and you bring the family? Like, what is it that what do industry folks say it needs to be? Or is it just painting the cafes and making them cozier? What is it?
No, that's absolutely right. I mean, in Starbucks created this idea of sort of the third place, right? Beyond, your work and your home where you could hang out, and also making coffee a little bit premium here in the US. But there's been a lot of competition that has undercut the company in terms of price, in terms of speed, and also in terms of new products. If you look at places like Dutch Bros, they just have these drinks like protein coffee drinks that really appeal to demographics like Gen Z. And at the same time, they've kind of pioneered a model of convenience. So it is almost like all of the above, right? Like one of the things that when you talk to Brian Niccol, he wants to make sure Starbucks stands out is by having the space, having the coffee shop where you can hang out. That is something that, those drive-through concepts like Dutch Bros don't really have, because by definition, they are drive-through. But at the same time, they also need to make sure that they have stuff that actually gets people in the door. And so that's why they've been also redesigning the menu. They are trying to focus on coffee because that's their heritage. And so they think that they can sort of distinguish themselves that way. But at the same time, they are adding those twists like that vanilla latte with the protein cold foam. I actually got to try it in Vegas. It's quite interesting. But it's like they can't go super focused on like purist coffee. They also recognize they need to have stuff that actually like catches people's eye, if that makes sense.
Daniela, I'm curious too about Brian Niccol. He has been so quiet. I mean, Tim and I have talked to him a lot when he was at Chipotle. He was very accessible. I've done some deep dives too with him for Businessweek magazine and for Bloomberg. I'm just curious, why is he kind of laying low?
It's interesting, the perception that he's laying low. I mean, I guess from my perspective, since Brian joined, he's been pretty clear about his vision and his plan. So I remember he joined September 9, September 10, he actually came out with like the broad outlines of his plan. And by October, they were putting him on the phone, to talk to reporters about what was happening at the company. I do think that part of what's happening is that while his vision is clear in terms of what he wants to accomplish, I mean, he knows he wants to bring back the coffee house. He wants to focus on coffee. He wants to speed up service. Sometimes the underlying tactics are changing a little bit. And so, the sort of direction of travel is clear. But just to give you an example, earlier this year, Starbucks said that they were going to bring more staffing to about a third of U.S. company-operated stores. So that excludes stuff like airports. It excludes Targets. Then later, they were like, no, actually, it's coming to all stores. Probably part of it was a little bit pressure from investors being like, all right, man, when are we going to start seeing results? But the tactics and sort of like the speed are changing a little bit, even though everyone knows like the direction of travel, if that makes sense.
Yeah, it does. You mentioned the changing menu and to get people into the door. What I learned from your story is that's a big part of Tressie Lieberman's job. Tell us about her.
So Tressie worked with Brian at Chipotle and at Taco Bell, actually. She told us that she's been working with Brian since she was in like her 20s. So she knows Brian quite a bit. And so she came over right before Starbucks. She was actually chief marketing officer at Yahoo. So she has broad experience. And so her remit is marketing. So how the company presents itself to customers, including the sort of rebranding as Starbucks Coffee Company. But also the menu, because I think they recognize that, yes, the company has had some hits, like, for example, cold foam, things like shaken espresso. One of the ways to know if something's been a hit is if competitors have copied it. And if you go to any coffee shop has those things. But at the same time, there were things they launched, like, for example, energy drinks last year that they've discontinued because they just didn't think were up to par. And so that's kind of what Tressie's doing. And she's described wanting to make the menus sort of modern and premium. And so one of some of the things they're looking at is like the protein latte, and also bringing fresh baking to Starbucks, because I don't know if this is common knowledge, but pastries at Starbucks come in a plastic bag that then gets reheated in an oven. So that doesn't really fit a definition of premium, which is, they're trying to justify the prices that they are charging, and they're trying to justify the experience. So that's sort of the direction that they're moving.
I will say their little egg bites, I think, are something my daughter really likes.
People love these egg bites.
They're popular. They're very popular.
I know, right?
Yeah.
They're kind of nice.
And if you see that, it's another example of Starbucks setting a trend that has caught on. Like even Costco sells egg bites now. So
can I ask you something? Wait, because I would say that we're three different generations. Do you go to Starbucks?
I do, but I also cover it. So sometimes I just go to see how things are.
Okay.
So
okay. Tim doesn't go.
I will not go unless
I don't go.
I'm falling asleep at the wheel and it's the only place.
Right. So I think.
So why not?
You
Tim?
do go? You do go?
No, I don't go.
I don't like the coffee.
And would you go if you didn't? I mean, this might be uncomfortable, but would you go just between the three of us if you didn't cover it?
Just between the three of us in front of everyone. I think I'm going to refrain from answering that question.
Okay.
You're the smartest one here because you're not getting yourself in trouble.
Like, there's lots of choices.
But I will say, I
think it's tough.
Well, I only have 1 cup of coffee a day.
I know.
And I have to have it at home because I can't do anything.
He's a little bit of a prima.
Well, the thing is, I don't know. I mean, I used to drink the coffee.
Yeah.
But then you move to New York and you're like, the options for coffee here
it's nuts.
are unbelievable.
There's so many.
Yeah.
I like a French press at home.
But people go, Charlie Pellet goes every day.
I know.
Katie Greifeld goes every day.
I think he now likes the
And
doodling.
I think that's the question, right?
Yeah.
I mean, there is a loyal base of customers, and some of the moves that Starbucks has made, in recent months, they changed their rewards program. They've just changed a lot about the experience. Does that keep the loyal customers or not? And then at the same time, does it bring new people? Like, maybe Brian will do something that will actually get Tim to come in the door.
No, it's not going to happen.
And it's just not going to happen. It's just not going to happen.
If it's like a Chipotle or if it's like a Chipotle bowl or a Doritos Locos taco, then maybe.
Then maybe. I don't know. What if he improves the food? That is also part of what he's trying to do.
Exactly. Right? Like you go and you increase the individual purchase. Hey, 25 seconds, China?
They are looking at selling a stake there. That is the latest information that we have because recovery has been tough and they want a local partner there to help them figure out what to do.
Because that's an important part of growth, right, for them?
Second largest market after North America. And they say they believe in it. So we'll see.
Final question. Pumpkin spice latte, too early, August 26th. Too early, right?
I don't know if it's earlier than other years, but it's not fall. It's definitely not fall. But I think it's earlier and earlier because it does give them a big sales bump. So maybe that's why.
Definitely not fall. Daniela Satori joining us, Bloomberg News restaurant reporter. Great story on the Starbucks CEO. It's a Business Week story. Check it out.
You're listening to the Bloomberg Businessweek Daily podcast. Catch us live weekday afternoons from 2 to 5 p.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business App. Or watch us live on YouTube.
Tiffany, salespeople call them the watch monsters. Oh my God, salespeople always have words for customers. The obsessives, the ultra wealthy shoppers who were sure they would be among the chosen few to get their hands on the rare limited edition Patek Philippe timepiece.
But what began as a celebration of the iconic jeweler and watchmaker has evolved into a cautionary tale, a lesson in how exclusivity, if mishandled, can dim the glow of luxury.
Jeanette Newman is Bloomberg News consumer reporter. She wrote all about how Tiffany turned their best customers into their loudest critics. She joined Tim and Bloomberg News equities reporter Nora Melinda.
This watch was particularly coveted and particularly special. So if, let's say, you wanted to just go in and buy the watch, you couldn't just walk in off the street and say, I love Patek Philippe. I want this very special watch. There were only 170 of them made. You would express interest in the watch. And then you would be told, okay, we'll Tiffany salespeople would tell you, we'll get back to you. And that's because this watch was very highly desired. And so there were many people who were trying to get it. And it was ultimately, as we report, at the discretion of Tiffany executives who ended up getting the 170 watches.
And that discretion is really where things got complicated for some of the folks who were argue, at least in lawsuits, that they were longtime customers of Tiffany and spent quite a bit of money at Tiffany. What did you find in your reporting?
So in the reporting, what I found is that, and I think it would also be helpful if you find it helpful too, just to kind of situate this moment. So we have to go back in time a little bit just to understand why this watch was the watch at the time and why now, even a couple years later, we're talking about it. I'm reporting on it because it's the sale of the watch is still having repercussions today. So this watch that was made by Patek Philippe went on sale in December 2021. And if you'll remember at that time, many people were feeling flush. We had extra pandemic savings. Some people still had some money left over from the stimulus checks. A lot of people were buying luxury goods. Demand for luxury goods was going through the roof. That included luxury watches. Some said at the time there was actually a bit of a watch bubble. People who maybe hadn't been interested in watches before all of a sudden got very interested in spending their pandemic savings on these luxury watches like Patek Philippe. So at this time, Patek Philippe says, okay, actually, we're going to discontinue one of the most beloved watches in the world, their 5711 model, which is the Nautilus 5711 model. They said, we're going to discontinue it. At that time, the watch world freaked out. It was a huge deal that amid this kind of watch bubble, one of the most important watchmakers in the world says, we're no longer going to sell the watch that everybody loves. And then they said, okay, so that caught everybody off guard. And then they caught people off guard again by saying, actually, there's going to be one final swan song for the 5711 line. We're going to make 170 of these very special edition watches to honor the 170 years that Patek Philippe and Tiffany had been working together. So an incredibly long-standing relationship in the luxury world. So Patek made 170 of these watches, and what was different was, as you said, the dial was in that kind of in that signature Tiffany blue, which is actually a patented color. If you go to the stores, everyone knows the Tiffany boxes are in that color. Now, Patek doesn't have that many retail stores, so it relies on Tiffany and other jewelers to sell its watches. So in the case of this blue dial watch, it was Tiffany that was tasked with selling the watches. And as you said, that's where things got a little bit complicated. So there was basically Tiffany executives realized that there was so much demand for these watches that they could encourage clients to spend between $2 to $3 million on jewelry in order to even get a shot at buying a watch.
And this is called, as I learned reading your piece, this is called bundling, and it's something that is typically done, but they're not real rules around it. It's kind of like understood, but not always in writing. It's typically done in high-end stores with luxury items. Explain that.
Exactly. It's all very informal. I think, talking to some people for this story, people would often mention, oh, right, that's kind of what you have to do if you want to get, similarly, you can't walk off the street and just buy a Birkin bag. Often what customers will say is you're encouraged to buy other goods in order to then get access to that Birkin bag. And that's, again, what some people in the industry call bundling. Other people call it tying. I would say one potential difference with that is, if you walk into an Hermes store and they're telling you to, potentially telling you to consider buying some other goods in order to be considered for a Birkin. That's kind of all within the confines of one store, right? And one brand. I think the difference here is that you had Tiffany, which was selling Patek watches, encouraging its clients to buy Tiffany jewelry in order to get access to the Patek watch.
So explain the alienation of some customers, these wealthy customers who expected to be able to buy this watch after spending money at Tiffany, but according to your reporting, ultimately weren't able to do that.
Right, and there was definitely some frustration based on our reporting, based on sources that we talked to with the sale of this watch. And I think, one kind of specific element that might be interesting to listeners is there was a charity auction of the watch in December 2021, and the watch went for a staggering $6.5 million, which is about 100 times its retail value. The watch itself only, obviously a lot for so many of us, but the watch itself only cost around $53,000 and it sold for $6.5 million. That initial sale fell through. The watch ultimately exchanged hands for $6.2 million. Still a lot of money. People who were interested in the watch saw that sale and said, well, this is a no-brainer investment. If I can get access to something that costs $53,000 and then potentially sell it for the market is showing that there's demand of up to $6 million. Well, that seems like a no-brainer investment. So what some of our sources said is that some people, again, saw that as a no-brainer investment and said, okay, well, if I'm being encouraged to spend $2 to $3 million on jewelry, that might be worth it because I think that I can resell the watch. Now, the thing about that auction is, in general, charity auctions, longtime collectors will look at charity auctions with a bit of a skeptical eye because sometimes, for example, the watchmakers themselves are involved in the bidding. So seeing that $6.5 million price as kind of a market price versus a price that's maybe more marketing oriented, I think was part of the issue according to our sources and according to our reporting. And then what happened to answer your question is people thinking the watch was worth this much. Some of them did get the watch. And then over time, over 2020, 2022 and into 2023, the value of the watch really fell. And now the watch sells in the secondary market for around $1.2 million. So obviously a very big drop, still a very expensive, very valuable watch, but not what people who were encouraged to, spend money on jewelry were expecting for this investment. And also to be fair, and I'm sure if you have, friends who buy watches, there's all kinds, right? I mean, some people buy watches, it's buy and hold, and there's some people who want to buy and sell. Other people bought the watch and never even didn't see it as a no-brainer investment or otherwise because they didn't see it as an investment, right? They saw it as, I want to buy and hold this because I love this watch and I want to have it. Others, the ones who were disappointed by the decline in the price, were seeing it as more of an investment that they could potentially flip, at least have the option to flip.
Jeanette, based on your experience covering the luxury space, is this normal? Are mishaps, mishandlings like this common?
I think, in this story, at the end of this story, we mentioned, I spoke to an anesthesiologist who, what he told us, he told a story of how he was trying to buy some Ferraris. He had one Ferrari that he really wanted, and he bought several Ferraris in order to try to get that Ferrari, and he never got that. Ferrari declined to comment on his kind of specific experience, and said, it doesn't encourage that kind of behavior. This anesthesiologist said that he's come across that game in the luxury world, and honestly, the way he said it is he's kind of sick of it. So I think that is a potential risk in the luxury world that some people like to engage in this game, and I think others find it tiring. I would say, speaking to some people who sell watches on the secondary market, one of the things that they say is they find that some of their clients come to them because they just want to be able to, tell me the price and then I'll buy it or I won't. I don't want to get involved in trying to spend money on X, Y, and Z that I might not even want in order to get what I actually do want. So I do think it definitely happens in the luxury world, and people can choose to continue to engage with it or say, that's not for me.
Jeanette, a great story. I learned a ton, including maybe I should have considered a career in anesthesiology.
Sounds like it,
considering
right?
that this anesthesiologist has bought 5 Ferraris or something.
I swear.
Really, really good stuff. Check out this story. It is the most read story on the Bloomberg terminal. The headline, you really can't beat it. Tiffany angers rich clients who wanted to buy a rare Patek watch.
This is the Bloomberg Businessweek Daily podcast. Listen live each weekday starting at 2 p.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business App. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Julia Child, Gordon Ramsay, Emeril Lagasse, Rachel Ray. These are just some of the many celebrity chefs that make a living cooking on television. Well, now the next generation of chefs are turning to YouTube, even TikTok, to learn new skills and establish their culinary reputations.
Plus, New York City vibes in London restaurants, that and a lot more from the Bloomberg Pursuits team. With us right now, the editor of Bloomberg Pursuits, Chris Raudser, also Bloomberg Pursuits food editor, Kate Crater. She is not in London. She's here in New York City in the studio with us, Carol.
I can't even tell you how much we've been talking about this all week. We're like,
we've all
Chris
done hugs. We group hugs already. Like we spent a bunch of time catching up, and
we're
now
supposed to be taping.
Now
like
we got
10
to do
minutes
work.
ago.
Now we got to do work.
We do. All right, we're going to talk a lot of food in a moment because there's so many stories that we want to get to. But first up, Chris, we just want to talk a little bit about green watches.
Yes, the most important news. There's a new color on watches, you guys.
How does this happen? Like, how does like the watch industry all of a sudden go green?
That's it's funny. Watches. There are not that many trends that can take over watches. There's like different styles of watches, different metals, sometimes different colors, and then it can. Every once in a while, there's like a big blue year or a big green year, and there's lots of stories, and everyone sort of collects these certain things. And this year, there is a wave of pistachio colored watches. And this is interesting only because, it's not that bold of a color. It's kind of a subtle color. It doesn't pop off your wrist, and it's not traditionally a color that people like in watches. But we've seen everything from Rolex to Hublot to Parmigiani to Oris all have watches this year in this color. And it's like they talk to each other, but they didn't.
That's what I find crazy. Kate, would you wear a green watch?
I absolutely would, especially if Chris told me which one to wear. And I want to know which of those pistachio watches you have, Chris.
Well, I have good news for you, Kate. There is a price range, and it ranges from about $6,000 per watch all the way up to $2.3 million per watch.
You just help me make my decision.
How can you have a $24,000 watch with a rubber strap? I'm just asking.
Yeah, that's a good question. Some people
hold on.
the rubber strap.
What about a $2.3 million watch with a rubber strap?
Exactly.
Yeah.
Because there is one of those.
Yeah, so that's a Richard Mille watch, and that's kind of that's sort of what these things cost. These Richard Mille watches are the billionaire's handshake, they call them. And this one is a flying tourbillon sapphire. It's a big chunky thing. It's the kind of watch that Kendall Roy watches on Succession, wears on Succession. The most popular one will be the Rolex Oyster Perpetual, which everyone's killing themselves to get this pistachio green color. My favorite is a Parmigiani watch, which is a skeleton in a beautiful slate green color. It is not affordable. I will not be buying it.
It's affordable to some people.
It's $70,000, but it's extremely beautiful, and you should look at the story online to check it out. But there's more inexpensive ones, like Oris has a cool one for $4,000, and Norcane, which is a very cool, sporty new company that we've covered, has one for $6,000.
All right. When I think of green, and when you said pistachio, I thought of ice cream and other things. So let's go to food now. YouTube, yay! I have to say, I can't tell you how many times when we're looking to cook something, we go to YouTube or social to figure out. Sounds like there's a whole new generation of chefs.
I was going to say, you could be a professional chef right now, Carol, the way you're talking.
I could not.
Well, let's see. You know what? You never know. Just watch a couple more videos. No, it's like this seismic shift. A couple decades ago, people would professional chefs or wannabe professional chefs would want to train in a kitchen, like a Thomas Keller kitchen or a Bobby Flay kitchen. And now they don't even need to do that. They just turn on their computer and watch some videos, and sooner or later they can actually open up their own place. It's been, to me, it's a seismic shift. It's amazing.
You have this great anecdote about James Lowe and wanting to, I don't even know what the right term is, but like fillet a tuna?
Yeah.
Is that what it is?
Butcher. I think you would say butcher a
Butcher
tuna.
a tuna, okay.
If you want to try this at home, Tim, butcher. I think you would be butchering
Easier
it.
said than done.
Truth. Total truth. Yeah, no, he's a very British chef, and there hadn't been tuna in his neck of the woods since he'd started cooking. He had like a 30-year career, and then all of a sudden, or whatever, because of the way that the government was able to manage the waters, tuna became available in Cornwall, and all of a sudden it became a sort of local ingredient for him. And so he bought one and then realized, now what? Because he'd never, ever butchered one before. And so he and his team sat there and watched YouTube and then carried a 400-pound piece of fish or whole fish into their kitchen. Like, it took over their dining room. They'd watched hours and hours. And he said it was a process that took hours, But
it's so funny to picture just a huge 400-pound
well, there is a
fish,
picture. If you
whole
look at the
fish being
story,
like,
there's this
no.
crazy, like that literally took over 5 tables of their dining room. Like that's how big the fish is. They didn't have the knives to do it. You know, it's an amazing story.
Maybe because it's the 50th anniversary of Jaws, but I saw this and it looked like a shark. Like all I could think about was the shark in Jaws. It's massive.
So 30 years ago, he would have had to fly to Japan or buy cookbooks or make a lot of mistakes.
Yeah, no, expensive mistakes.
Yeah.
Precisely. Yeah, no, I think, or he would have just brought somebody in who knew how to do it. But yeah, no, just think about, like, even if you're looking at the most detailed manual of a cookbook, it only takes you so far when you're presented with this fish.
I don't know. I do this all the time, not for cooking, for anything that I have to build that comes with an instruction booklet. I'm not good with the diagrams, the instruction booklets. I got to watch a YouTube video. Unfortunately, those exist for everything.
Tim, you can open up a restaurant with Carol.
I was more thinking about assembling children's toys, which is why I was looking at Chris, because I know he does the same thing.
You know what's crazy? I don't cook. I'm not a great cook. It's a joke in my complete family. But I'll be on Instagram and like people making things, and I just find it really relaxing and soothing.
Yeah.
It's pretty amazing.
Yeah, I was just going to say it's actually cool because in London, where I'm based right now, these pizza chefs, there was this whole thing during the pandemic. A couple people who weren't so happy with their jobs started watching pizza videos because there were all this U.S. style pizza all of a sudden available, or like there were all these videos from like Dave Portnoy, Barstool, and stuff like that. And now there's a couple newly minted pizza makers in London thanks to YouTube.
And they're very hot, very popular. People
They're very popular. Pizza.
Perfect.
Don't bet against pizza.
Perfect segue to talk about pizza in London. Usually we talk about pizza in New York City, but Kate, you've got a story out that's talking about a kind of vibe of New York City taking over London restaurants. When I think of food in London, I think of really good Indian food, and then of course the classics, fish and chips and the like. But apparently you can get a good pizza there now.
Yeah, no, you're absolutely right, and it feels a bit ironic because the U.S. brand isn't so hot over in the UK and Europe, and tourism is way down here. I think it's going to be down by 2.5 million people, they estimate, in New York City by the end of the year, and yet New York vibes are super hot in London, and it's got to do with steak. Like if you go somewhere now, you'll see a cheeseburger on an ambitious menu, which you never would have seen before, and steaks and oysters. But it's also an energy, which is the part that I think is really fascinating. The Brits aren't used to being spontaneous. If you know any Brits, like you will probably co-sign on that.
But we love all of you who watch and listen to us.
Yes, yay you guys. But now, so they traditionally haven't had walk-ins at restaurants, and now a lot of these super cool London restaurants have places for walk-ins, but it's also an energy. It's the way they arrange their tables. So instead of there being like rows and rows of tables and chairs, they turn the chairs in different directions, and that changes the energy in the room.
Kate, two people forwarded me this story and asked me, does that mean that the martinis are bigger? Or are they still
bigger in London?
Are they still thimble size?
No, they're pretty modest. I think if your friends are like doing a measurement, they will say that. But there's a big. I think the thing that this story inspired the most debate on is where the martini's from, because technically and historically, or not technically, but the history is a bit fuzzy. But it's supposedly from the Knickerbocker Hotel in New York City, and that makes Brits very, very mad.
You can get a Cosmo in London now.
Yes, you can.
Wow. I'm just saying.
True story.
Who'da thunk? Where do we want to go? We want to
go to sleep.
Oh, yeah. This story, both Tim and I talked about this. We're like, okay, there were some good strategies, but there are a lot of CEOs who don't seem like they've got this under control.
So we do this feature every month in Business Week where we call it the CEO Diet. We talk to a bunch of CEOs. Kate is in charge of it. Thankless task. And she talks to a bunch of CEOs about their habits and what they do, what they eat, what they drink, what they do in the morning. And so this month we did how to optimize your sleep, which CEOs everyone wants to know, and they have a lot of thoughts about.
Yeah, they do. No, it is it's kind of amazing. The CEO of Dogfish says he takes a bath underneath a picture of Andre 3000.
Playing a flute.
Sorry, yeah, thanks for that detail.
Which is why finds creepy.
Which freaks his wife out, and that's why they have separate bathrooms. The CEO of Uber, which is a very famously data-oriented company, says he used to be obsessed with data and like compete against himself every night, and now he just puts away all of his screens and goes to sleep. And that, to me, is super ironic.
That is so telling. My husband is obsessed with data, too. And he'll be like, I got a 67 or I got a 75. I'm like, well, how do you feel? He's like, I don't know. I got a 75.
Yeah.
But what was amazing, there were so many folks that I thought, who was it?
Peter McGinnis at Chobani, well, formerly of Chobani. Carol, you and I have spoken to him quite a bit. Now he's at Impossible Foods. Yeah. He's basically says, maybe I should get more sleep. He's not good at it.
Yeah. That doesn't surprise you, though, right? Like CEOs, you think of like never sleeping and not maybe just like.
But that was like 10 or 15 years ago.
Yeah.
Now sleeping is cool again. Like now sleeping is cool. Being healthy is like in right now. That's what it feels like.
That's exactly right. I think you used to brag about the minimal amount of sleep you needed. And now you're like, look at me, 67, 75. Or now, if you don't get a good night's sleep, if you're changing time zones too many times, it's something, that you sort of agonize over and say, like, I need to get better at it.
Yeah, I love the guy. Was it the head of Vito Coco? I think he talked about napping a lot.
Yeah.
Yeah, 40 minutes nap. A 40-minute nap every single day.
Hey, Tim, before we start our show, we'll just tell everybody, hey, we're going to take a nap. See like how that feels.
I don't know, Chris, when was the last time you got to take a bath for 30 minutes every night?
I haven't taken a bath in years. I think about it. It makes me want to cry thinking about it. The Rainey Williams from Beverly Hills Estates, the CEO, I thought had good advice. It was like usable,
she has
lots
lot
of stuff.
Advice.
Yeah, I take magnesium, zinc, and ATP, along with a cortisol balancer to help regulate stress levels, which I would really like. I don't know. I have to find out what that is. And that's just the start, she says.
And then she takes a relaxing shower, full skin care, and self-care regimen.
She's doing it right. And a red light mask.
Right.
To be honest, like her answer was twice as long as this. This is an edited version of what she does. Like she's doing it right.
Can I just tell you, I went down a rabbit hole on those red light masks after I read this.
Here's my routine before I go to bed. Clean up everything that my kids have taken out that day.
Yeah.
Clean up do all the dishes. Start making lunches for them for the next day. And then look at my phone.
Yeah, that's about what mine is.
Yeah.
All right. Or maybe
no sound bath. You don't do a sound bath.
No sound bath. Or maybe what you should do is go see this new Elvis show in London, and maybe that'll put you to sleep.
Yeah.
Only got about a minute or so here. Sarah Rappaport, she did a review. Didn't seem like she liked it, Chris.
There's a show called Elvis Evolution in London right now, which everybody is loving to hate. Only fools rush in. Audiences are not all shook up. Sorry. So Sarah went, and we have been excited about this show because it was supposed to be AI. It was supposed to be like the ABBA Voyage. So like you were going to see Elvis, like a new incarnation of Elvis interacting with the audience, and that's not what it is. It's like you walk in, it's an immersive experience, it's a tour, so you start in a diner, and then there's actors, and then you go to a bar, and then at the end you see a video of Elvis on stage. And Sarah says it's quite disappointing. People are asking for their money back. It's £300 for VIP tickets. One older guy got really mad during the show and started complaining loudly, and then security tackled him and took him out, and they canceled the rest of the shows for the evening. It is
terrible.
Yeah, it's not.
How can you make Elvis bad?
Well, I guess there's probably a reason they started
See the
it in
show
London.
And you'll know, Carol.
And not
I know
in the
how
US.
you can.
Kate, you're going to have to go see it.
Really?
Just for work,
We'll take that. We'll take that as a no. This has been such a treat. You guys made our week. Thank you so much. So appreciate it.
Thank you guys.
Thank you.
Our thanks to Chris Rouser, the editor of Bloomberg Pursuits, and to Bloomberg Pursuits food editor, Kate Crater.
And that wraps up the weekend edition of Bloomberg Business Week from Bloomberg Radio. Thank you so much for joining us.
I'm Tim Stenovec.
And I'm Carol Massar. Have a good and safe weekend. Be sure to check out Pursuits just to see the big, was it a tuna? It was a tuna, right? It was a tuna. Just to see that picture alone. It's pretty wild.
This is the Bloomberg Business Week Daily podcast. Available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 2 to 5 p.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business App. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.